Hello everyone, this is Bill Hall for Money and Markets. It's Wednesday, September 10th, and I'm pleased to bring you this market insight. As Wall Street begins its stretch run from Labor Day to the end of the year, the big news, the really big news came out of Europe last week. And that was the announcement by the ECB that they were going to lower interest rates to practically zero. That means almost nothing, and they're going to buy back loads of asset-backed securities. The reason the European Central Bank had to do this is because the European economy is a wreck. They are teetering on the verge of recession over there. So the actions by the ECB were appropriate based on the underlying economic conditions in Europe. The European Central Bank's actions also follow on Mario Draghi's comments from about 18 months ago when he said that he would do whatever it takes to save the economy in the Eurozone. And with this announcement, the European Central Bank has stepped up and backed up those comments. This announcement is important to investors because all of this newly created liquidity in Europe is bound to find its way into the global financial markets and continue to support the market's current lofty levels and probably allow the markets to drift higher. Now let's look at our second chart, and you'll see that we still continue to have troubles here in the US. Yes, the US economy is doing better, and on a relative basis, much better than the European economy. But you have to remember, it's sort of like being the tallest of Snow White's seven dwarves. The market is still, the economy is still growing slowly. So even though we're doing better, we're doing much better, it's relative to other things that are not doing as well. And we see this in this second chart because job growth in the U.S., it has been slow. There was a new announcement last week, last Friday, that talked about how many new jobs have been created in the month of August. And you can see on this chart that number was disappointing. And the reason I keep focusing on jobs and I keep focusing on wage growth is because 70% of the U.S. economy is based on the consumer. And to get the U.S. economy moving again, we need real wage growth and we need real jobs. But similar to Europe, an anemic U.S. economy right now is a good thing for investors, even though it's ironic. But that's the way it is because the U.S. Federal Reserve also has its own easy money policies, just like the European Central Bank, and those policies from the Federal Reserve are likely to continue as long as the U.S. growth in the economy is below trend line. Okay, let's turn to investments now. We've talked about the economy. Let's look at investments, and let's think about the three components of stock market returns again. Our third slide shows the three components of stock market returns that I've discussed in previous podcasts. The first component is dividends. The second component is earnings growth. The third component is change in the price-earnings ratio. Those three components are the three and only three things that drive stock market returns. Now moving to our fourth slide, we see how those components of stock market returns have happened so far in 2014. So far for 2014, we've gotten about 1% of stock market returns from dividends, we've gotten 4% from earnings growth, and we've gotten 5% from the fact that people are just willing to pay more for stocks in the U.S. currently than they were at the beginning of 2014. So you get 1% from dividends, 4% from earnings growth, 5% from the change in the PE ratio. You add those three components together, 1 plus 4 plus 5, that equals the 10% return that we've seen so far this year in the U.S. stock market. Moving along to our fifth slide, we see a chart of the valuation levels, or the PE ratio levels in the major stock markets across the globe. And what we see is that the U.S. Stock market, represented by the blue line, has the highest valuation. And what we also see is that the emerging markets, represented by the dark brown line, have the lowest valuation. Therefore, as a price-conscious value investor, I'm looking at the emerging markets as the place to consider investing some money currently because of its favorable valuation level. And specifically, I'm considering the iShares Emerging Markets ETF, symbol EEM, to make that investment. The ETF EEM represents a low-cost, efficient way to get your money invested in the emerging markets. So in conclusion, I would say consider the emerging markets as a place to invest your money, specifically using the ETF EEM to take advantage of favorable valuations and benefit from an upward move in the price-earnings ratio. This is Bill Hall for Money and Markets, and I look forward to speaking with you again next week.